Let's connect with Ajay Srivastava to talk markets. Ajay, if I would have done a dipstick 6 weeks ago, the general view on the street was that market kahin nahi jaane wala hai. Nothing will happen to the markets. Buyer beware, protect your downside, and right now don't do anything which could hurt you in the pre-election period. But I guess markets are markets. They can really surprise you, and this time they pleasantly surprise us.
A pleasant surprise, absolutely. And I think one big variable which all of us excluded was Donald Trump in our, in the people we track and the news we track, because I think he's been the most instrumental person if you just look at a rally, because he's the one who really badgered the Jerome Powell into saying that, listen, interest rate will not go up, and now they're saying going to reverse. So let's see the genesis of this rally. It came out of nowhere because that's the one variable which no analyst worth its salt, including us, could track and say, yes, that will happen. Now, it's happened. So therefore, one more variable now is the stance of the Federal Reserve thanks to Donald Trump tweets. So I have subscribed to the tweets now to say, now start listening to the gentleman. He is pretty influential as far as our markets are concerned as well.
Ajay, what should one do now? For those who missed the rally, should they wait for election verdict and then come back in, or just jump in now, because this market has rediscovered momentum? Election verdict is still about 2 months away, and a lot could change, from now to the election verdict.
See, you've heard of election is not a variable in decision making. It can be a variable in terms of timing, perhaps, as what you're alluding to. But I think what decision we have to make is, as investors, is first of all is how much are we invested? Because quite a bit of the market is fairly invested. Now, if you're fairly invested, you ride the whole tide. Number two is, where is your portfolio focused upon? The rally is so-called very good rally, but lots of people feel missed out because they were in the mid caps and small caps and so on, which haven't done as much, some liquidity, but not the price action. So the second question is, if you have still got a distribution which is 60-40 in terms of, or 70-30 in terms of mid cap predominance, you still keep needing to move your this thing. It doesn't matter what stage of the market you are in. If you are in the market, you need to keep moving your portfolio more and more toward large cap, because even if, let's take election rally can go either ways, it doesn't matter. The economic fundamental tell you a story of Indian economy is the story of large companies. It's not a story of small companies. So whether you look at the private space, the unicorn, so-called unicorn, look at public space, it's all the story of large companies. And in an economic slowdown, we don't expect election will change the GDP to 7, 8 or 8%. GDP will still be 6.2, 6%. In a 6% pyramid environment, you can't expect small and mid caps to outperform the large caps. So the thesis remains the same. If you are invested well, keep recalibrating your portfolio to the larger side. Number two is, if you don't have 10 sweethearts of this market, it doesn't matter what time you got. You still just need to keep investing. If you don't have it, buy now. You can never time it. Maybe you can get it cheaper sometime, but still I say, take the top 10 and keep buying them irrespective of the state of the market. Over a period of 2 years or so, you will average it out. But there's always a place to start, and today is the day to start with the 10 best companies of India.
Okay, so Ajay, basically you're saying buy more of the same and buy them as and when the market does dip. But what about the broader markets, Ajay? Because even if I see the recovery that's played out in March, and the good thing about March is that some of these in pockets, mid and small caps have also recovered very, very fast and have tried to catch up with the benchmark recovery as well. Do you not believe there's higher alpha scope there? Or would you say play it safe irrespective of whatever?
2 years back, the search for alpha took us into a territory which we are still paying for. Believe me, we are still paying for. So I'm not sure the alpha lies in that slot. It's the second time round. Once bitten, twice shy. We may be wrong, but that's not where alpha is. Alpha is going to come when you got your investment portfolio right in the top 10, 20 companies. Now, alpha can come if you go to sectoral. And I think sectoral is very important in general mid-cap. Sectoral plays are becoming relevant as the real estate has become a little relevant. The metal space has become relevant. In our view, alpha is in the PSU stocks which give phenomenal dividend yield. I think these are the three spaces where you work with, you can do well. You can't do very well with an auto ancillary make an alpha out of it. You can't do well with an engineering mid-cap out of it. You can't do well with a infrastructure road company out of it, because those are variables which you can't control, and they're not going to do well. Certainly not going to do well in the next year or two. So if you're really in a search of alpha, I would say three sectors which come to mind is Real estate, where commercial real estate is doing very well at this point of time, at least it's got enough buyers of commercial real estate in terms of bulk buying. And the number 2 is metal space, beaten down quite a bit, very decently valued. And the third is the PSU. Phenomenal dividend yields await you, but you got to be patient for the price action on them. So 3 places look for alpha, but generally speaking, the 100 to 250 crore company space that we're talking about, I think that's a dead duck. I think it's over and done. Let's not even waste our money on chasing them and tracking them. Not only for the reason of financials, corporate governance can hit you one day, promoter issues can hit you the second day. And and let's look at the disposition of the regulatory authorities. There's also not favoring the small caps at this point of time. The compliance burden is so huge that they will just drown under the cost of compliance. So, and lastly, banks are the preferred bet. They are the holy deities of the market. So you don't run away from the banks. You've seen Ind AS now. HFCs have to do Ind AS, NBFCs have to follow Ind AS, the banks don't have to follow Ind AS. Now, how much more of a preference would you give to a sector of the economy? So, ride with the regulator. They're saying banks is a good place. We'll keep it lowly regulated. Okay, we'll ride with that. We are here to make money, not to argue about fairness and justice.
With that, and I'm going to keep financials aside, because financials, you need size, you need reach, you need balance sheet, you need trust. There are a lot of factors. We both know that. But if I look at the real smart outperformers on a 5-year period, it's Bajaj Finance. Today it's a mega cap, but it was a mid cap 5 years ago. Pidilite, a good company, but it was part of the mid cap index couple of years ago. So the history tells us that if you get the mid cap name right, your chances of making serious money is far greater than what you're doing with mid cap, with mega cap stocks. And again, how index works, Ajay, is that when the company is at its peak, that's the time it finds recognition into Nifty or the Sensex.
Well, you're right, if you look at the universe, how do you select it? If you look at the universe of mid-cap 5 year back, there were whole amounts of series of stock which were doing very well at that point of time. All right. Now, if you're going to pick the winners, yes, you're right. You named a couple of winners. Bajaj Finance always was in a different category. Let's be honest about it. Leave it aside. But for every winner, there are 4 losers in this category, and you may win 40-60% on one stock, but you lose 80-90% on the other stocks. Now, where do you go with that kind of a mix? So you got to be terribly lucky and terribly smart to be in the category. I don't think, at least I personally can say that I'm not that smart to look at 5 years down the line or 7 years down the line. I look at what's happening in the next 24 months at the rate the world is changing and the economics is changing, the economy is changing. So yes, you're right theoretically that if you hit pay dirt, it's like a horse race. That if you really pick out the winner, your winnings are 10:1 or 20:1. The question is, how many times do you lose till you pick the winner up, and how much more losses can you rack up? A private equity can do it. Sequoia does it so well. They invest in 100, 3 becomes unicorn, they cover up for the 50 losses they make. But as an individual investor, if 1 or 2 shares tank big time, it just destroys your portfolio returns altogether. And that's the thesis where I say that mid cap and small cap is a dangerous place to get, because you got to be dot on the ball, you got to be patient with it, and if you make a wrong choice, God help your hard-earned post-tax money. And that's the danger you do. Risk your post-tax money in a Pidilite 5 years back and other stocks. You could be in Arcom, you could be in Jet Airways, you could be wherever as well. Look at Arcom, look at Unitech. 580 rupees a share to 2 rupees a share. You could be in any of those stocks and you could have your fortune wiped out. So, so it's nice to pick out the winners and present to the market, but the pitfalls at the back are for every one winner, there are at least 50 losers. And that's the game. If you like roulette, play roulette, but don't play that game.
Yeah, given that the house always wins.
Yeah. Just very quickly, Ajay, but commodities seem to be at play this morning. We've been speaking about cement, we've been speaking about metals in particular, and that theme does seem to be playing out on various economic data on both sides and expectations of a price hike on the cement front. Commodities, metals, specifically on the back of an improvement in the Chinese growth scenario, would you take a look at this pocket of the market?
I think more than demand scenario, the real fact is they're dirt cheap stocks at this point of time. in terms of whatever the intrinsic value is, you price to book. Just use an index of price to book and you see how dirt cheap these stocks are. Someday, something will happen to this eventually if we are factoring in a world growth even 2.3 or 3% and India would grow 7 or 8% and China would grow 4 or 5%, etc. Some point of time the trajectory of this metal will change, and lots to do with speculative pressures on this market, lots to nothing to do with fundamentals. So when you have a market where you can buy a stock which is intrinsic to the world growth at less than 1 time book value, I think it's worth a play at that point of time. So I can't predict this copper prices, I can't predict metal prices, really I can't at the end of the day. But what I can say certainly is that if the company is at 0.8 times genuine book value, I think sooner or later it'll catch up in price. Same thing happening in OMCs in India, same thing will happen in metal, same thing. So when you're in that territory, you're also on the safer side that your downsides are limited, your upsides can be what is called alpha driven, and you could make a disproportionate return for your investment. Also a question of risk and return. You know, you can buy the most sparkling stock with the highest price and expect a return out of it, but that's a risk return ratio you want to play with. You can buy these stocks, limited risk, okay, go down by 10-20% more, you will still get better value out of it. So I think the game play is not the change in fundamental, the game plan is that these are dirt cheap stocks to play with right now.
All right, Ajay, thanks so much for joining us this morning and sharing with us an outline.
You're welcome. Thank you very much.
Okay.
But I was told that you have promised 1 share for every viewer today.
If everyone's attempting these April Fool's jokes.
Once we get this stake, Ajay, we'll surely give that 1 share to the viewer.
All right. Thank you very much. All right.
Thank you.